Before we begin, please remember that the information provided in this video is for educational and informational purposes only. I am not a financial advisor, and this presentation is not financial, legal, or tax advice. The cryptocurrency market is highly volatile and carries a significant risk of loss. You should consult with a qualified professional before making any financial decisions. Your capital is at risk. I lost $1,247 on my very first crypto trade, and it had nothing to do with picking the wrong coin. It wasn't because Bitcoin crashed or some meme coin went to zero. It was a stupid, expensive, and completely avoidable mistake. I chose the wrong platform, and because of that, I got hit with fees I didn't see coming. I panicked because the interface was a confusing mess, and I sold at the worst possible moment. That $1,000 lesson is the entire reason I'm making this video, so you don't have to learn it the hard way. Because let's be honest, you're here because you've decided to take the leap. You've seen the headlines, you've heard the stories, and you want in. But the second you decide to buy, you hit a brick wall. You go to the App Store, type in crypto, and you're staring at a list of names that sound more like sci-fi villains than financial institutions. Coinbase, Kraken, Gemini, Binance US, Crypto.com, KuCoin, Uphold. The list goes on and on. They all have slick logos, they all promise to be the easiest and most secure way to buy Bitcoin. And that's the trap. They are not all the same. Not even close. Choosing the right platform is the single most important decision you will make in your crypto journey. It's more important than the first coin you buy. It's the foundation of your house. Get it wrong and the whole thing can come crumbling down. Pick the wrong one and you could be paying 5 to 10 times more in hidden fees on every single transaction. Pick the wrong one and you could wake up one morning to find the platform is insolvent and your money is gone forever. Pick the wrong one and you could find yourself in a legal nightmare with the IRS because the platform isn't even compliant in the United States. But if you pick the right one for you, you set yourself up for success from day one. You trade with confidence, you sleep well at night knowing your assets are secure, and you keep more of your own money. So my promise to you is this: by the end of this video, you won't just know which platform to choose. You will have a simple, powerful 5-point framework that will allow you to evaluate any crypto platform like a pro. We are going to cut through all the marketing hype and focus on what actually matters. This isn't about shilling my favorite exchange. This is about giving you the tools to make your own intelligent decision. This framework is built on 5 core pillars. Get these 5 things right and you're golden. First and most important, security and trust. This is non-negotiable. Is my money actually safe? What happens if the exchange gets hacked? What happens if the company goes bankrupt like FTX? We're going to talk about insurance, proof of reserves, and the security features that are an absolute must. Second, fees and the true cost of trading. This is where most beginners get absolutely wrecked. They see zero commission and think it's free. It's not. We'll expose the hidden costs like the spread, deposit and withdrawal fees, and network fees, so you know exactly what you're paying. Third, ease of use. Can a normal person actually navigate this thing? Some platforms are beautifully designed for absolute beginners, while others look like the cockpit of a 747 and are meant for professional traders. We'll help you find the one that matches your skill level. Fourth, coin selection and features. Does the platform even sell the coins you want to buy? What if you want to do more than just buy and hold? We'll look at features like staking, earning interest, and other things that can help you grow your investment. And fifth, a pillar that is critically important for everyone watching in the US, legal and regulatory status. Is this platform legally allowed to operate in the United States, and more specifically in your state? The regulatory landscape is a minefield, and using a non-compliant exchange is one of the fastest ways to lose your money or get into serious trouble. Today we're diving deep into the most important pillar of all, security and trust. Because if your money isn't safe, nothing else matters. The fees don't matter, the features don't matter, nothing. The ghost of failed exchanges like MTGOX and FTX haunts this industry for a reason. Hundreds of thousands of people lost everything overnight. Their life savings gone. So how do we prevent that from happening to you? First, we need to talk about something called proof of reserves. After the FTX collapse, where they were caught secretly gambling with customer funds, this became the new industry standard. Proof of reserves is basically an audit where an exchange publicly proves that they hold enough crypto to cover all of their customer deposits. It's them showing you, the customer, that your money is actually where they say it is. If a US-based exchange you're considering does not provide regular, audited proof of reserves, that is a massive red flag. Close the tab and walk away. Second, let's demystify insurance. You'll see a lot of platforms advertise FDIC insured. This sounds great, but you need to understand what it actually covers. FDIC insurance only applies to the US dollars you have sitting in your account, your cash. It does not cover your cryptocurrency. Let me repeat that. FDIC insurance does not protect your Bitcoin, your Ethereum, or any other crypto asset. If the exchange gets hacked and your crypto is stolen, the FDIC will not give you a dime. So what does protect your crypto? Some of the top-tier exchanges purchase private insurance policies from giants like Lloyd's of London to cover their digital assets held in hot wallets, the online wallets used for active trading. This is a huge plus. It shows they are serious about protecting customer funds. You need to dig into their security page and see if they have this kind of private insurance and what it covers. Another term you might see is SIPC insurance, but this typically only applies if the platform is also a registered securities brokerage, which is rare for pure crypto exchanges in the US. The bottom line on insurance is, your cash is likely protected, but your crypto is only protected if the exchange has gone the extra mile to get a specific, private, digital asset insurance policy. The third piece of the security puzzle is your own account security. Any reputable exchange, without exception, must offer two-factor authentication or 2FA. This is where, in addition to your password, you need a second code, usually from an app on your phone like Google Authenticator, to log in. Do not, under any circumstances, use an exchange that doesn't support app-based 2FA. And please do not use SMS or text message 2FA. It's notoriously insecure and can be compromised through something called a SIM swap attack. Use an authenticator app. It's non-negotiable. Beyond 2FA, look for features like address whitelisting. This allows you to create a pre-approved list of crypto addresses you can send funds to. So even if a hacker gets into your account, they can't just drain your funds to their own wallet. They can only send it to addresses you've already vetted. It's a simple feature that adds a powerful layer of protection. So, to recap Pillar 1, when you're looking at a platform, you need to ask 3 questions. 1. Do they provide regular audited proof of reserves? 2. What is their insurance situation? Do they have FDIC for cash and, more importantly, a robust private insurance policy for digital assets? And 3. Do they offer crucial security features for you to use, like app-based 2FA and address whitelisting? If the answer to any of these is a no, it's not the platform for you. The risk is simply too high. In this game, we don't gamble with our security. We start with the safest, most reputable, and most transparent platforms available to us here in the United States. And in the next part, we're going to take that same forensic approach to the place where platforms hide their biggest secrets: their fee structure. Think of it like this: you've found the perfect flight online. The price is incredible. You click buy, and suddenly you're hit with a seat selection fee, a carry-on bag fee, a checked bag fee, a convenience fee for booking online. And by the time you're done, that amazing price is a distant memory. This is exactly what crypto platforms do, but they're often much, much better at hiding it. It's a game of financial whack-a-mole, and it's designed to slowly bleed your account dry. They call it death by 1,000 cuts. And it's the #1 reason why many beginners see their portfolio shrink, even when the market is going up. So let's pull back the curtain. The first and most common fee you'll encounter is the trading fee. This is the price you pay for the service of buying or selling crypto. But it's not a single, simple number. Most reputable exchanges in the US use what's called a maker-taker model. And understanding this one concept is like getting a cheat code for saving money. Imagine a local farmer's market. A maker is the farmer who brings their produce, sets up a stall, and puts a price tag on their tomatoes. They are making a market. They are adding liquidity, putting orders on the books that don't exist yet. A taker is the person who walks up to the stall, sees the price, and buys the tomatoes. They are taking from the market that already exists. They are removing liquidity. In the crypto world, when you place a limit order, meaning you set a specific price you're willing to buy or sell at, and you wait for the market to come to you, you are a maker. You're the farmer setting up the stall. Because you're adding stability and depth to the market, the exchange rewards you with a lower fee, the maker fee. When you place a market order, meaning you say, I want to buy Bitcoin right now at whatever the best available price is, you are a taker. You're the customer grabbing the tomatoes off the stall. You're taking immediate liquidity, and for that convenience you pay a slightly higher fee, the taker fee. For most beginners, you'll be a taker most of the time. You just want to buy some crypto and be done with it. So when you're comparing platforms, the taker fee, is usually the number you need to focus on. These fees are typically a percentage of your trade size, ranging from as low as 0.1% on more professional platforms to over 0.6% on simpler ones. It might sound small, but if you trade $10,000 over a year, that's the difference between paying $10 in fees and paying $60. It adds up. But here's where it gets sneaky. This is the secret that the so-called commission-free platforms don't want you to know about. They shout from the rooftops, zero trading fees, and no commissions. And it sounds like a dream come true, but it's a magic trick. The real fee is hidden in plain sight, in something called the spread. The spread is the difference between the highest price a buyer is willing to pay for an asset and the lowest price a seller is willing to accept. In simpler terms, it's the difference between the buy price and the sell price. Think about changing money at an airport kiosk. You see two prices for the euro, a we buy price and a we sell price. If you want to buy euros, you pay the higher price. If you want to sell your euros back, you get the lower price. That gap between the two prices, that's the kiosk's profit. That is the spread. Crypto platforms do the exact same thing. A zero-fee platform might show you a buy price for Bitcoin of $60,100, but their sell price at that exact same moment might be $59,900. That $200 difference is the spread. When you buy from them, you're instantly down $200 on paper, because the highest price anyone else on that platform is willing to pay for it is less than what you just bought it for. They bake their fee directly into the price of the crypto itself. It's not a line item on your receipt. It is the receipt. So, a platform with a 0.5% trading fee might actually be far cheaper than a zero-fee platform with a 1.5% spread. The first one is honest about its cost. The second one is hiding it inside a shell game. The only way to know for sure is to open the app, pretend you're going to buy 1 Bitcoin, see the price, and then pretend you're going to sell 1 Bitcoin and see that price. The difference is the true cost you're paying. Don't trust the marketing, trust the math. Okay, so you've navigated the trading fees and the spread. You've bought your crypto, but the gauntlet isn't over. Now you have to deal with deposit and withdrawal fees. Depositing US dollars is usually free if you use an ACH bank transfer, which is the standard way. But be careful. Some platforms will charge you a hefty percentage, sometimes 3% or more. If you want the convenience of using a debit or credit card, that's an instant 3% loss on your investment before you've even started. Unless it's an emergency, always stick with the free ACH transfer. Withdrawal fees are where things can get really painful, especially when you're moving crypto itself. If you want to withdraw US dollars back to your bank account, it's often free or a very small flat fee. No problem there. But if you want to move your Bitcoin from the exchange to your own personal wallet, which, as we discussed in the last part, is a critical step for security, you'll pay a crypto withdrawal fee. This isn't always the platform being greedy. They have to pay a network fee to the Bitcoin miners to process the transaction. But some exchanges will charge you far more than the actual network cost and pocket the difference. And here's the kicker. These fees are often a fixed amount of the crypto, not a percentage. For example, the fee to withdraw Bitcoin might be 0.0005 BTC. If Bitcoin is at $60,000, that's a $30 fee. That might be reasonable if you're moving a whole Bitcoin, but it's absolutely crippling if you're only trying to move $100 worth. You'd lose 30% of your money just to move it. So, you have to look at their withdrawal fee schedule. A good platform will have dynamic fees that reflect the actual network congestion, or they'll have very low, fixed fees. A bad platform will have a single, high fixed fee that punishes small investors. And finally, we have the miscellaneous junk fees. These are the little gremlins in the system. Some platforms, though less common in the US now, might charge an inactivity fee if you don't trade for a few months. Others might charge account maintenance fees. It's rare, but you have to scan the fine print. So how do you put this all together? You have to ask yourself, what kind of investor am I? If you're a high-frequency trader, making dozens of trades a week, your number one priority is the lowest possible maker-taker fee. A difference of 0.1% is a massive deal when you're trading huge volumes. The spread is also critical. You need a platform built for professionals. If you're a buy-and-hold investor, someone who plans to buy a chunk of crypto and not touch it for years, those trading fees are less important. You might only make a few trades a year. For you, the most important factors are the deposit fees and, critically, the crypto withdrawal fees. You want to buy your crypto cheaply, and then move it to your secure personal wallet for the lowest possible cost. A platform with zero withdrawal fees or very low ones is your holy grail. And if you're a beginner just dipping your toes in buying small amounts, you have to be most wary of the spread and the fixed withdrawal fees. Those simple zero-commission apps with wide spreads and high fixed withdrawal fees are designed to prey on you. They make it easy to buy, but they make it expensive to own and even more expensive to leave. Your mission, then, is to become a fee detective. Go to the website of any platform you're considering. Don't look at the homepage, that's just marketing. Find the link at the bottom of the page that says, Fees, Pricing, or Fee Schedule. It's there. They are legally required to disclose it. Open that page and look for these 4 things: the maker-taker fee tiers, their policy on the spread, the fiat deposit/withdrawal fees, and the specific crypto withdrawal fees for the coins you want to buy. Create a simple spreadsheet. Compare 2 or 3 top US-based exchanges side by side. Run the numbers for a hypothetical $500 purchase. How much crypto do you actually get after the fees and spread? How much would it cost to move that crypto to your own wallet? The answer will become crystal clear. The platform that looks cheapest on the surface is almost never the one that actually is. By doing this 5-minute exercise, you are arming yourself against the single biggest drain on crypto portfolios. You're choosing transparency over trickery. You're ensuring that more of your hard-earned money goes into your investment, not into the pockets of a marketing department. We've now built the foundation. We know how to find a platform that is secure, regulated, and transparent about its costs. We've locked the front door and checked for hidden fees. But now comes the exciting part. What do we actually buy? The entire point of this is to invest in crypto assets, but not all platforms are created equal. Some offer hundreds of obscure coins, while others stick to the tried and true blue chips. The platform you choose dictates the universe of assets you have access to, and that choice can be the difference between buying the next big thing or being stuck holding last year's forgotten hype. In the next part, we'll dive into the wild world of coin selection and how to match a platform's crypto library to your own investment goals. Think of a crypto exchange's coin library like a grocery store. Some are like a small corner convenience store. They've got the essentials, milk and bread. In the crypto world, that's Bitcoin and Ethereum. They're reliable, everyone knows them, and they're what most people start with. Platforms like PayPal or Cash App are your crypto convenience stores. They make it incredibly simple to buy your first Bitcoin, but if you go looking for organic, gluten-free Himalayan pink salt, you're going to be disappointed. Your shopping list is limited to the absolute basics. Then you have the big chain supermarkets like a Safeway or a Kroger. These are your Coinbases and Krakens. They have the milk and bread, of course. But they also have a robust organic section, a decent international aisle, and maybe even a deli. This is where you find not just Bitcoin and Ethereum, but also the top 20 or 50 projects. The big names, the established altcoins like Solana, Cardano, Avalanche, and Chainlink. These are the platforms for people who have heard about more than just Bitcoin and want to diversify into other major projects that are building the future of the internet, so-called Web3. Finally, you have the gigantic international specialty warehouse, the kind of place you need a map to navigate. This is where you find everything. Ingredients you've never heard of from countries you can't pronounce. In crypto, this is an exchange like Crypto.com or, for more advanced users, KuCoin. They list hundreds, sometimes thousands of different cryptocurrencies. This is where you find the brand new, the obscure, the high-risk, high-reward gems that haven't hit the mainstream yet. It's exciting, but it's also overwhelming and filled with far more risk. So the first question you need to ask yourself isn't, which platform has the most coins? The question is, what kind of shopper am I? Let's break this down into 3 investor profiles. See which one sounds most like you. First, we have the bedrock investor. Your philosophy is simple. Stick to the proven winners. You see Bitcoin as digital gold, a store of value against inflation. You see Ethereum as the foundational settlement layer for a new digital economy, digital oil, if you will. You're not interested in chasing the hot new dog with a hat coin. You want security, stability, and a long-term investment in the 2 titans of the industry. You prioritize ease of use and trust over a dizzying array of options. If this is you, your choice of platform is straightforward. You don't need the international warehouse. A platform like Cash App, Swan Bitcoin, or even the basic version of Coinbase is perfect. They are designed for this exact purpose, to make buying and holding Bitcoin and Ethereum as simple as possible. The limited selection isn't a bug. It's a feature. It removes the noise and the temptation to gamble on unproven projects. For the bedrock investor, a short, curated list of high-quality assets is a sign of a focused, secure platform. Next, we have the ecosystem explorer. You've done your homework. You understand that crypto is more than just digital money. It's about smart contracts, decentralized finance, NFTs, and a whole new internet being built from the ground up. You're not just investing in a coin. You're investing in a technological ecosystem. You want to buy Solana because you're impressed by its transaction speed. You want to hold Polygon because it's solving Ethereum's scaling issues. You might even want to buy some Uni, the token for the Uniswap exchange, because you believe in the future of decentralized trading. If you're an ecosystem explorer, the convenience store won't cut it. You need the supermarket. You need a platform like Coinbase, Kraken, or Gemini. These exchanges have a much more rigorous vetting process than the list everything warehouses. When they add a new coin, it's usually a project with a solid team, real technology, and a significant community behind it. It's not a guarantee of success, of course, nothing is, but it's a filter. These platforms offer a curated selection of the most important and promising projects beyond the big two, and they often provide services like staking, which allows you to earn rewards on your holdings, something we'll cover in detail later. For you, the ideal platform offers a wide but not infinite selection of quality projects. Finally, we have the altcoin adventurer. You have a high tolerance for risk and you're on the hunt for the next 100x return. You understand that for every project that explodes in value, 100 others will fail and go to zero. You're willing to take that chance. You want to get in on projects before they get listed on Coinbase, because you know that a major listing can often cause a huge price spike. You're looking for low market cap coins, new narratives, and the hidden gems buried deep in the crypto market. If this is you, you're heading straight for that giant international warehouse. A platform like crypto.com, which boasts a massive list of coins, is your playground. These platforms are often much quicker to list new and trending tokens. The trade-off? The due diligence is often less strict. The responsibility to research and vet these projects falls almost entirely on you. You're operating on the frontier, and it's both thrilling and dangerous. For the true adventurer, this might even mean eventually graduating to decentralized exchanges or DEXs, where you can buy tokens the moment they're created, but that's a whole other level of complexity and risk. For now, a centralized exchange with a massive library is your base camp. Now, here's a critical piece of information specifically for our US audience. The United States is not one single market. It's 50 different ones. Just because an exchange operates in the US doesn't mean its full menu of coins is available to you. The biggest hurdle is in New York, which has the infamous BIT license. It's a very strict and expensive regulatory framework that causes many exchanges to either not operate in New York at all, or to offer a severely limited selection of coins to New York residents. You might see a YouTuber in California trading a hot new coin on Kraken, but when you log into your Kraken account from Buffalo, that coin is nowhere to be found. It's not a glitch. It's regulation. This applies to other states as well, which have their own specific rules. Always check the platform's supported coin list for your specific state before you sign up and fund your account. So before you get mesmerized by a platform advertising over 800 coins, take a step back. Start with yourself. Are you a bedrock investor, an ecosystem explorer, or an altcoin adventurer? Your answer to that question will narrow down your options from dozens of exchanges to just a handful. It ensures the platform you choose is a reflection of your own strategy, not the other way around. Don't let a platform's massive library tempt you into becoming a high-risk gambler if your goal was to be a steady, long-term investor. Choosing the right coin library is about aligning the platform's philosophy with your own. Once you've found that match, you've found a place where you can confidently execute your strategy. You've found your store, you know what's on the shelves, and you're ready to start building your portfolio. But just as you get to the checkout aisle, confident in your choices, you're hit with a series of charges you didn't see coming. A spread fee, a trading fee, a network fee, a withdrawal fee. Suddenly, that basket of assets is costing you way more than you thought. These hidden costs can be the silent killer of your returns. And navigating this confusing world of fees is exactly what we're breaking down next. Let's talk about the single most misunderstood and frankly the most misleading part of choosing a crypto platform, the fees. It's a labyrinth designed to confuse you. You see a flashy ad that screams, "Zero commission trading." And you think you've hit the jackpot. You think you've found the one honest player in a sea of sharks. But let me tell you, in the world of finance and especially in crypto, there is no free lunch. Zero commission is one of the most effective and most deceptive marketing phrases ever invented. Think of it like this. You walk into a restaurant with a giant sign outside. Free entry. No cover charge. You feel great. You sit down, order a simple bottle of water, and when the bill comes, they've charged you $15. You're confused. But the entry was free. The waiter just smiles and points to the fine print on the menu. A $5 glass rental fee, a $5 ice cube chilling fee, and a $5 service and ambience charge. The entry was free, but they got their money and then some. Crypto platforms work the exact same way. They just call their fees by different names. So let's pull back the curtain and expose the three main ways these platforms take a slice of your pie. First, you have the most obvious one, trading fees. This is the direct cost of buying or selling a cryptocurrency. It's the platform's bread and butter. But even this isn't straightforward. You'll typically see a maker-taker model. This sounds complicated, but the concept is simple. Imagine a farmer's market. The makers are the farmers who set up their stalls and put their produce out with a price tag. They are making the market. They are adding liquidity, giving people something to buy. The takers are the customers who walk up and immediately buy an apple. They are taking from the market. In crypto, if you place an order that doesn't get filled instantly, say you want to buy Bitcoin but only if the price drops to $60,000, you are a maker. You're adding your order to the book. If you just hit the market buy button and purchase Bitcoin at the current price, you are a taker. Platforms want more makers because it makes their market look busy and full. So they often reward makers with a slightly lower fee than takers. We're talking fractions of a percent, like 0.1% for a maker and 0.2% for a taker. But if you're trading thousands of dollars, that difference adds up fast. But here's where the zero commission platforms get you. They don't charge a direct trading fee. Instead, they make their money on something far more subtle, the spread. The spread is the silent predator of the crypto world. It's the difference between the price a platform is willing to buy a coin from you and the price they're willing to sell it to you. Go to any currency exchange at an airport. You'll see a buy price for euros and a sell price. They are never the same. That gap is their profit. Crypto platforms do the exact same thing, but on a digital lightning-fast scale. Let's say the true market price of Ethereum is $3,000. A zero-fee platform might show you a buy price of $3,030 and a sell price of $2,970. You don't see a line item that says fee, but they've built a 1% fee right into the price on both sides of the transaction. You're paying $30 more than you should when you buy, and you're getting $30 less than you should when you sell. For a beginner making a small purchase, this hidden cost can be way higher than a simple transparent 0.2% trading fee on a professional exchange. They bank on you not checking the actual market price on a different site. They bank on the psychological power of the word free. Okay, so you've navigated the trading fees and the spread. You've bought your first bit of crypto. You're feeling good. Now comes the second major fee category, deposit and withdrawal fees. These are the tolls for moving money in and out of the platform's walled garden. Getting your US dollars onto the platform is the first hurdle. Using a bank transfer, or what's called an ACH transfer, is usually free. It's slow, taking a few days, but it's cheap. But people are impatient. They want their crypto now. So they see the option to buy with a debit or credit card. This is almost always a trap. Platforms will slap on a hefty fee for this convenience, often somewhere between 3% and 5%. On a $1,000 purchase, that's an instant $50 loss before you've even started. You're paying a premium for speed. But the real gut punch often comes when you try to leave. Let's say you've learned about self-custody, and you want to move your Bitcoin from the exchange to your own secure, private wallet. This is where they hit you with the withdrawal fee. And this is critical. There are two parts to this fee. First, there's the actual blockchain network fee, the cost to process your transaction on the Bitcoin or Ethereum network. This is unavoidable. It's like paying for postage. But on top of that, the platform often adds its own surcharge. They might charge you a flat fee of, say, 0.0005 Bitcoin to withdraw. If Bitcoin is at $60,000, that's a $30 exit fee. Some platforms with low trading fees have outrageously high withdrawal fees because they know that once you're in their system, they've got you. They make it cheap to get in and expensive to get out. Let's walk through a real-world scenario. Meet Sarah. She has $1,000 and wants to buy Ethereum. She finds two platforms. Platform A, ProTrade, has a 0.2% trading fee. Platform B, Simple Crypto, advertises fee-free trading. Sarah, like most beginners, chooses Simple Crypto. Just sounds better. She goes to buy her $1,000 worth of Ethereum. The real market price is $3,000, but Simple Crypto's price is inflated by a 1.5% spread, so she buys it at $3,045. She doesn't pay a fee, but she only gets about $985 worth of actual Ethereum. She's already down $15. Her friend, who uses ProTrade, also buys $1,000 of Ethereum. He pays the 0.2% trading fee, which is $2. He ends up with $998 worth of Ethereum. Right off the bat, he's $13 ahead of Sarah. A month goes by. They both decide to move their crypto to a secure hardware wallet. Sarah goes to withdraw from Simple Crypto, which has a low fixed withdrawal fee of just $5. Great. Her friend goes to withdraw from ProTrade and discovers their withdrawal fee is a fixed 0.01 ETH. At a price of $3,000, that's a $30 fee. Suddenly, Sarah's choice looks better. After all is said and done, Sarah is down a total of $20, while her friend is down $32. So who made the right choice? The answer is, it depends entirely on your plan. If you plan to buy and hold on the exchange for a long time, or trade frequently without withdrawing, ProTrade's low trading fees are better. But if your goal is to buy crypto and immediately withdraw it to your own wallet, Simple Crypto's high spread but low withdrawal fee might actually save you money. There is no single cheapest platform. It's a myth. It's about finding the platform whose fee structure is cheapest for your specific strategy. Are you a day trader making dozens of trades a week? You need the lowest possible maker-taker fees, and you don't care about withdrawal costs. Are you a long-term investor who buys once a month and immediately moves it to cold storage? You should be terrified of high withdrawal fees and can tolerate a slightly higher trading fee. Are you just dollar cost averaging a tiny amount every week? A platform with a high flat fee per trade will eat you alive, and you should look for one with a simple percentage. So before you ever deposit a single dollar, you need to play detective. Open up the fee schedule page on every platform you're considering. It's usually buried at the bottom of the website, in tiny font. And you need to look for these three numbers: the trading fee or the typical spread, the deposit fee for your preferred method, and most importantly, the exact fee to withdraw the specific crypto you want to buy. Write them down. Compare them. Do the math for your own situation. Because finding the right fee structure isn't just about saving a few bucks. It's about taking control. It's about refusing to be the person who pays $15 for a bottle of water. You've worked hard for your money. Don't let it get silently siphoned away by hidden charges and deceptive marketing. Now you've done the work, you've found the platform with the perfect fee structure for your goals. You've saved yourself hundreds, maybe thousands of dollars in the long run. But every single penny of that is completely, utterly meaningless if you wake up one morning, log in, and find that your account balance is zero. Because the cheapest platform in the world is worthless if it's not secure. And the biggest, most terrifying threat to your crypto might not be some hacker in a dark room halfway across the world. It might just be the platform you chose to trust. And we'll uncover that chilling reality next. Because the story of the biggest crypto collapse in history isn't about a sophisticated hack. It's about trust. Misplaced trust. It's the story of FTX. Just a few years ago, FTX was the golden child of crypto. They had Tom Brady, Larry David, and Steph Curry telling you it was the future. They had their name plastered on the Miami Heat's basketball arena. Their founder, Sam Bankman-Fried, was on the cover of magazines, hailed as a boy genius, the next Warren Buffett. He was testifying before Congress, shaping the very laws that would govern the industry. FTX felt safe. Felt inevitable. It felt like putting your money in a digital Fort Knox run by a visionary. And then, in the span of about 10 days in November 2022, it all turned to dust. Billions of dollars in customer funds vanished. Not hacked. Not stolen by an outside force. They were gone because the platform itself, the very company people trusted to safeguard their assets, had been treating customer accounts like its own personal piggy bank. They were taking customer Bitcoin, customer Ethereum, and using it to make incredibly risky bets through a sister company, Alameda Research. When those bets went bad, the money was gone. And when customers rushed to withdraw their funds, a classic bank run, the vault was empty. The chilling reality is this. When you leave your crypto on an exchange, you don't actually own it. You own an IOU. The exchange holds the keys to the crypto, and you hold a promise from them that they'll give it back when you ask. FTX taught the world a brutal lesson. Sometimes those promises are broken. The company goes bankrupt, and your IOU becomes a worthless piece of paper in a decade-long court proceeding. This is the single most important concept to understand in crypto security. Not your keys, not your crypto. So, how do we protect ourselves from the next FTX? How do we look under the hood of a platform and see if the engine is actually there? It comes down to asking the right questions and looking for 3 critical signs of a secure and trustworthy platform. First, and this is the big one, how do they store your assets and are they insured? This is called custody. When a platform holds your crypto, they are its custodian. The nightmare scenario, which FTX embodied, is when a platform mixes customer funds with its own operational funds. It's like a bank using the money from your savings account to pay its electricity bill or gamble on the stock market. It's a catastrophic conflict of interest. A top-tier platform in the US will be crystal clear about their custody solution. Look for platforms that use what's called a qualified custodian, which is often a separate, legally distinct and regulated trust company. For example, Coinbase doesn't just lump all its assets together. It uses the Coinbase Custody Trust Company, which is chartered in New York and subject to audits and capital requirements. This creates a firewall. It makes it significantly harder for the exchange side of the business to borrow from the customer asset side. It's a structural safeguard against temptation and fraud. If a platform is vague about who holds the keys or if they're held by some affiliated, unregulated entity in a foreign country, that is a gigantic flashing red flag. Now let's talk insurance. This is one of the most misunderstood topics for beginners. You see the letters FDIC insured on a platform's website and you breathe a sigh of relief. Don't. FDIC insurance, which protects your bank deposits up to $250,000, only applies to the US dollar cash balance you hold on the platform. Let me repeat that. It covers your cash, not your crypto. If the platform goes under, the FDIC will help you get your dollars back. They will not do a single thing to help you recover your lost Bitcoin or Ethereum. The same goes for SIPC insurance, which protects securities like stocks and bonds. Crypto is not currently considered a security in that context. So, does any insurance exist for crypto? Yes, but it's different. The best exchanges carry private commercial crime insurance. This policy doesn't protect you if the company goes bankrupt like FTX. What it does protect against is theft from the exchange itself. Specifically, if a hacker manages to breach the platform's systems and drain its hot wallets, which are the internet-connected wallets used for daily transactions. A platform like Gemini, for example, has made a big deal about its insurance coverage for its hot wallet. It's a valuable layer of protection against external hacks, but it is not a safety net against internal fraud or platform insolvency. You need to know the difference. The second critical sign of a secure platform is transparency, specifically something called proof of reserves. This is the crypto industry's direct response to the FTX disaster. The question everyone had was, how could we have known they didn't have the money? Proof of reserves is the answer. It's an auditing procedure that allows a platform to publicly prove that it holds the assets to back up all of its customer deposits. Essentially, they use cryptographic methods to create an anonymous snapshot of all customer balances. They then prove they hold the private keys to wallets that contain at least that much crypto. It's like a bank allowing independent auditors to come in, count all the cash in the vault, and then publish a report saying, yep, the money's all there. Platforms like Kraken and Binance have been pioneers in this, regularly publishing these attestations. Now, it's not a perfect system. It's still a snapshot in time, and it doesn't always show the company's liabilities. But in a world where trust has been shattered, it's a powerful signal. A platform that voluntarily subjects itself to this level of public scrutiny is showing you it has nothing to hide. A platform that refuses to provide proof of reserves or gives vague excuses is asking you to just trust them. And after FTX, just trust us is no longer good enough. The third and final piece of the security puzzle isn't about the platform's big picture policies. It's about the tools they give you to protect your own account. Because even the most secure fortress in the world is useless if you leave the front door unlocked. The absolute, non-negotiable baseline is two-factor authentication or 2FA. This means that to log in, you need not only your password but also a second piece of information, usually a temporary code. But here's the crucial part. Not all 2FA is created equal. Many platforms will default to sending that code to you via SMS text message. This is convenient, but it's dangerously insecure. Hackers can use a technique called SIM swapping, where they trick your mobile carrier into transferring your phone number to a new SIM card that they control. Once they have your number, they get your 2FA codes, and they can drain your account in minutes. You must use an app-based authenticator. Tools like Google Authenticator or Authy generate the codes directly on your phone, completely independent of your phone number. It's a small change in habit that represents a massive leap in personal security. If a platform doesn't offer Authenticator App 2FA, close the tab and never go back. Beyond that, look for more advanced security features. One of the best is called address whitelisting. This feature allows you to create a pre-approved list of crypto addresses that you're allowed to withdraw funds to. If a hacker gets into your account, they can't just immediately send your crypto to their own wallet. They would first have to add their address to the whitelist, a process which usually triggers a security alert to you and a mandatory waiting period like 24 or 48 hours. That waiting period is your lifeline. It's the time you need to realize you've been compromised, lock your account, and save your funds. Security isn't just a feature. It's a foundation. It's the difference between investing and gambling, between building wealth and buying a lottery ticket. We've talked about the internal threats like the catastrophic failure of FTX and the personal security tools that put the power back in your hands. But there's another shadow that looms over every US-based crypto user. It's not a hacker, and it's not a fraudulent CEO. It's the government. Navigating the complex, ever-changing maze of American regulation is just as critical as checking a platform's insurance policy. Because choosing a platform that's on the wrong side of the law could leave your funds frozen, or worse, in a legal black hole you can't escape from. And that's exactly where we're going next. Let's talk about that legal black hole. Imagine this: you find a slick-looking crypto platform. The fees are low, they offer 1,000 different coins, and signing up is as easy as giving them an email address. No ID, no questions asked. You deposit a few $1,000s, make some great trades, and your portfolio is looking fantastic. Then one morning you wake up, try to log in, and the website is gone. A simple 404 error page. You check social media and there's panic. A government agency, maybe the SEC, maybe the Department of Justice, has seized the domain. The company, it turns out, was operating illegally in the United States. Your funds? They're now evidence in a multi-year investigation. You have no clear way to claim them, no customer service to call, and no legal protection, because you were using a service that was never supposed to be available to you in the first place. You are in a regulatory no man's land. That is the black hole. And it's a scenario that has played out time and time again. Navigating the world of crypto regulation in the United States isn't just a suggestion. It's the single most important act of self-defense you can take as an investor. Problem is, it's not simple. It's a messy, overlapping, and constantly evolving patchwork of rules that can feel like a labyrinth designed by lawyers. Unlike the stock market, which has one primary federal regulator in the SEC, the crypto world has multiple agencies all vying for jurisdiction, often with conflicting views. Think of it like this: you have the federal government trying to draw a map for the whole country, but at the same time, each of the 50 states is drawing its own slightly different map. And you, the user, have to find a path that's valid on both maps simultaneously. It's confusing, but understanding the key players makes it manageable. First, you have the big federal agencies. The two most important ones you need to know are the SEC and the CFTC. The Securities and Exchange Commission, or SEC, is the big one. Their main job is to protect investors. They do this by regulating securities. Now, what's a security? The official definition comes from a 1946 Supreme Court case involving a Florida citrus grove, of all things. It's called the Howey test, and without getting into the legal weeds, it basically says if you're investing money in a common enterprise with the expectation of profit from the efforts of others, it's probably a security. The current head of the SEC believes that almost every crypto asset, with the possible exception of Bitcoin, fits this definition. This is a huge deal. If a crypto token is a security, then the platform listing it has to follow the same strict rules as the New York Stock Exchange. They need to register with the SEC, provide detailed disclosures, and protect investors from manipulation. Many platforms haven't done this, which is why you see the SEC constantly filing lawsuits against them. When a platform gets sued by the SEC, it can be forced to delist coins, halt services, or even shut down, leaving users in the lurch. Then you have the Commodity Futures Trading Commission, the CFTC. They regulate commodities. Think of things like gold, oil, and wheat. The CFTC has stated that Bitcoin and other similar cryptocurrencies are commodities. So, they oversee the markets for things like Bitcoin futures and options contracts. While the SEC is focused on the initial investment contract, the CFTC is focused on the trading of the underlying asset as a commodity. So right away, you have two powerful federal agencies looking at the same industry through two different lenses. A platform has to figure out how to stay on the right side of both. But it doesn't stop there. The third major player is FinCEN, the Financial Crimes Enforcement Network. This is a bureau of the Treasury Department. Their job isn't to decide if crypto is a security or a commodity. Their job is to stop money laundering and terrorist financing. This is where Know Your Customer or KYC rules come from. When a platform asks you to upload a picture of your driver's license and take a selfie, they're doing it to comply with FinCEN regulations under the Bank Secrecy Act. They are required by law to verify your identity to make sure you're not on a sanctions list or trying to move illicit funds. This is actually a massive green flag for you as a user. If a platform lets you sign up and trade significant amounts of money with just an email address and zero identity verification, they are willfully violating federal anti-money laundering laws. And if they're willing to break that law, what other laws designed to protect you and your money are they ignoring? A platform that enforces KYC isn't being nosy. They're being compliant and, frankly, protecting themselves and their users from being a hub for criminal activity. So you have the SEC, the CFTC, and FinCEN at the federal level. But remember that second map? The state level one? This is where it gets even more complicated. Many states have their own specific laws for companies that transmit money, and a few have created entire licensing frameworks just for crypto. The most famous, or perhaps infamous, example is New York's BitLicense. It's a notoriously expensive and difficult license to obtain. As a result, many crypto platforms simply choose not to operate in New York at all. You might find a platform that's perfectly legal and available in California, Texas, and Florida, but if you live in New York, you're blocked. This happens in other states too, like Washington or Hawaii, which have their own stringent rules. So, how do you, a beginner, possibly cut through all this legal jargon and make a safe choice? You don't need a law degree. You just need to know what to look for. Here is your practical, step-by-step checklist for vetting a platform's legal standing. First, go to the platform's website and scroll all the way down to the footer. This is the boring part of the site that most people ignore, but for you it's a treasure map. Look for links like licenses, legal, disclosures, or terms of service. A legitimate, regulated platform is proud of its compliance and will often list the states where it holds a money transmitter license or is otherwise authorized to operate. If you can't find this information easily, that's your first red flag. Transparency is key. Second, open up their terms of service. I know it's a wall of text, but you don't have to read all of it. Use your browser's find function, Ctrl+F or Command+F, and search for your state's name. The terms will almost always have a section that explicitly lists the states or jurisdictions where their services are not available. If you see your state on that prohibited list, stop right there. Don't try to use a VPN to get around it. If there's ever a dispute, the platform will simply point to their terms and say you violated the agreement, potentially giving them grounds to lock your account and your funds. Third, here's a pro-level tip. You can verify their claims yourself. For any platform operating in the US, they should be registered with FinCEN as a money services business, or MSB. FinCEN has a public, searchable database on their website. You can literally go there, type in the legal name of the crypto exchange and see if they are registered. This is a powerful tool. It's a direct look into whether they've taken the most basic step to comply with federal law. Finally, look at the overall character of the platform. Where is their corporate headquarters? Is it in a well-regulated country like the United States? Or is it in a tiny island nation with a reputation for lax financial oversight? Do they have a physical address and a real leadership team you can look up on LinkedIn? Or are they a faceless, anonymous entity? A company that is subject to US laws and regulations is accountable. If something goes wrong, there is a legal system you can turn to. If your exchange is based in a jurisdiction with no extradition treaty and opaque corporate laws, you are effectively on your own. Choosing a platform that takes regulation seriously isn't the most exciting part of crypto, but it is the foundation upon which everything else is built. It's the difference between building your financial future on bedrock and building it on quicksand. The platforms that play by the rules are the ones that are building for the long term. They're the ones that will still be here in 5 or 10 years. The ones that cut corners and operate in the gray areas are ticking time bombs, and you don't want your life savings to be anywhere near them when they go off. Now, once you've done your due diligence and found a handful of platforms that are secure, insured, and most importantly legally compliant in your state, you've successfully built the fortress that will protect your assets. You've laid the foundation. But a strong foundation is useless if the house built on top of it is impossible to live in, or if the landlord is charging you hidden fees at every turn. Now we need to talk about the actual experience of using the platform. We need to look at user interface, fees, and the specific tools they offer. Because a confusing platform or a predatory fee structure can drain your account just as fast as any hacker or regulatory shutdown. And that's our next mission. So let's break down this mission into 3 critical components. First, the user interface or UI. This is the cockpit of your trading vehicle. It's everything you see and touch, the buttons, the charts, the menus. When you log into a platform for the first time, does it feel like sitting in a brand new intuitive car where everything is exactly where you expect it to be? Or does it feel like you've been thrown into the cockpit of a space shuttle with 1,000 cryptic switches and blinking lights and no instruction manual? For a beginner, a simple, clean UI is not just a luxury, it's a safety feature. Think about a platform like the standard version of Coinbase. It's designed for one primary purpose: to make buying and selling crypto as easy as buying a stock on Robinhood or a product on Amazon. Big, clear buttons, simple price charts. It holds your hand through the process. This is fantastic when you're just starting. The goal is to reduce the chance of making a costly mistake, like accidentally placing a market order for 10 times what you intended because a button was confusing. A simple UI minimizes that risk. It builds confidence. But here's the trade-off. Simplicity often comes at the cost of control. As you get more experience, that hand-holding can start to feel restrictive. You might want more data, more advanced order types, more granular control over your trades. This is where you see the split between a platform's beginner version and its pro or advanced version. Coinbase has Coinbase Pro, Kraken has Kraken Pro. These are the manual transmission versions of the car. The dashboard is more cluttered, filled with tools like order books, depth charts, and advanced charting indicators. It can be overwhelming at first glance, but to an experienced trader, each of those tools provides a vital piece of information, an edge. So the question isn't which UI is better? The question is which UI is better for you right now? My advice is to start with the simplest one available. Go to the platform, create an account. You don't even have to deposit money yet, and just click around. Can you easily find the Bitcoin chart? Can you figure out how to place a hypothetical buy order? If you feel lost and frustrated within the first 10 minutes, that's a major red flag. Your focus should be on making smart trading decisions, not fighting the platform itself. The cockpit should feel like an extension of your will, not an obstacle course. Now let's talk about the second and arguably most important component, the fees. Because this is where the house always wins if you're not paying attention. Fees are the silent killers of your portfolio. They are the slow, constant drain on your engine's power that you might not notice day to day. But over months and years, they can leave you stranded. Crypto platforms make money in a few different ways, and they can be incredibly sneaky about it. The most common fee is the trading fee. This is usually a small percentage of your transaction, but it's not always that simple. You'll often hear the terms maker fee and taker fee. A taker is someone who places an order that gets filled immediately at the current market price. You are taking liquidity off the books. This is what most beginners do when they click the big Buy Now button. Taker fees are typically higher. A maker, on the other hand, is someone who places an order that doesn't get filled immediately, like a limit order to buy Bitcoin only if the price drops to a certain level. You are making a new market by adding liquidity to the order book. Because you're helping the exchange, maker fees are usually lower, and on some platforms they can even be zero. Understanding this distinction is your first step to saving a fortune in the long run. Always look for the platform's fee schedule. It should be easy to find. If they hide it, run. But that's not the only fee. The second silent killer is the spread. The spread is the difference between the buying price and the selling price of an asset at the same moment. Some platforms, especially the super simple, zero commission ones, make their money here. They might not charge you a direct trading fee, but they'll sell you crypto for slightly more than its market value and buy it from you for slightly less. It might only be a fraction of a percent, but on large trades or over hundreds of transactions, it's a massive hidden tax. It's like a currency exchange at the airport that offers no commission, but gives you a terrible exchange rate. The fee is just baked into the price. And then you have the miscellaneous fees, deposit fees, withdrawal fees, network fees when you move your crypto off the platform. These can add up. Some platforms might charge you $10, $20, even $30 just to withdraw your own crypto to your own private wallet. That's outrageous. You need to read the fine print. Before you commit a single dollar, you need to know exactly how much it will cost to trade, how much it will cost to hold, and how much it will cost to leave. A platform with a slightly more confusing UI but rock bottom, Transparent fees is often a much better long-term choice than a sleek, simple platform that's secretly nickel-and-diming you to death. Finally, let's talk about the third component, the tools. If the UI is your dashboard and the fees are your fuel efficiency, the tools are what the engine can actually do. What kind of performance and features does this vehicle have? The most basic tool, which every platform has, is the ability to place market orders, buy or sell right now at the best available price. But that's like a car that can only go forward at one speed. You need more control. The next level up is limit orders, which we talked about. This lets you set the exact price you're willing to buy or sell at. This is your gas pedal and your brake, it gives you control. Then you have stop-loss orders. This is one of the most critical risk management tools for any trader. A stop-loss is an order you set in advance to automatically sell your crypto if it drops to a certain price. It's your emergency parachute. It's the seatbelt and airbag of your trading vehicle. If you're in a trade and the market suddenly turns against you while you're asleep or at work, the stop-loss can save you from a catastrophic loss. A platform that doesn't offer basic stop-loss orders is, frankly, not a serious trading platform. It's a toy. Beyond that, you enter the world of advanced tools. You have charting software with technical indicators. Think of this as your advanced GPS and weather radar, helping you analyze market trends and predict potential movements. You have things like margin trading or futures, which allow you to trade with borrowed money. This is the turbocharger. It can dramatically amplify your speed and your profits, but it can also cause your engine to explode if you don't know exactly what you're doing. For a beginner, I would strongly advise staying away from margin until you have months, if not years, of experience. Some platforms even offer automated trading bots or copy trading, where you can automatically mimic the trades of a professional. This can sound like a cheat code, a self-driving car. But remember, you're still the one liable if that car crashes. You need to understand the strategy you're copying. So when you evaluate a platform's tools, you're looking for a balance. It must have the essential safety and control features, like limit orders and stop-losses. The more advanced tools are nice to have for the future, but they shouldn't be the deciding factor right now. Don't buy a Formula One race car if you're still learning how to drive a stick shift. Master the fundamentals on a reliable vehicle first. Find a platform that gives you the essential tools to protect yourself and grow, without overwhelming you with options that could lead you to ruin. So now you know how to judge the machine itself, the cockpit, the cost of the ride, and the power of the engine. You've found a platform that feels right, has fair fees, and gives you the control you need. But there's one more giant piece of this puzzle. You've picked your car, you understand the costs, you know how the dashboard works. But where can this car actually go? Because some platforms only give you a map to the biggest cities, Bitcoin and Ethereum. Others give you a key to 1,000 hidden backroads, a universe of other assets, each with its own treasures and its own dragons. Choosing that map, and understanding what's on it, that's our next critical step. So let's unroll that map. What you'll see first are the two great continents, the ones everything else is built around, Bitcoin and Ethereum. Think of Bitcoin as digital gold. It was the first, the original, the one that started it all. Its primary purpose is to be a store of value, a way to hold wealth outside of the traditional system. It's slow, it's deliberate, and it's incredibly secure. It's the bedrock. Then you have Ethereum. If Bitcoin is gold, Ethereum is like a global decentralized supercomputer that anyone can use. It's not just about sending money, it's about building things on top of the network. These things are called smart contracts, which are just bits of code that run automatically when certain conditions are met. This is the engine that powers most of what you hear about in crypto today, things like DeFi or decentralized finance and NFTs. It's the programmable, flexible foundation for a new kind of internet. For a brand new beginner, most platforms in the US will, at a bare minimum, offer you access to these two. They are the New York and Los Angeles of the crypto world. They are essential, well-established, and have the most infrastructure built around them. Starting your journey by understanding these two is never a bad idea. But look closer at the map. Beyond those two continents, you'll see thousands of islands, cities, and towns. These are the altcoins, short for alternative coins. And this is where the choice of your platform becomes dramatically important. Some platforms, like the beginner-friendly ones, might only show you a dozen or so of the bigger, more established cities. They've curated the map for you, trying to keep you on the well-paved highways. Other platforms throw the whole globe at you. Every backroad, every hidden village, and every potential dead end. So why does this matter? Because not all altcoins are created equal. Not even close. Let's break them down into a few simple categories so you can understand what you're looking at. First, you have what are called layer 1s. This sounds technical, but the concept is simple. These are other blockchains like Ethereum that are trying to do the same thing but faster, cheaper, or in a slightly different way. Think of them as competing operating systems. If Ethereum is Windows, you have projects like Solana, Cardano, or Avalanche acting like macOS or Linux. They are all foundations you can build on, each with its own community, its own technology, and its own trade-offs. Platforms that list a lot of these are giving you a choice of which digital nation you want to invest in. Next up, you have DeFi tokens. Decentralized finance. This is the idea of rebuilding traditional financial services like lending, borrowing, and exchanging assets, but without the banks and middlemen. When you buy a DeFi token, you're often buying something like a governance share in that project. It's almost like owning a tiny piece of the bank itself, giving you a say in how it's run and potentially a share of the fees it generates. These can be incredibly powerful, but they're also complex. They are the financial districts of our crypto map. And then we have to talk about the Las Vegas of the crypto world. The meme coins. You've heard of them. Dogecoin, Shiba Inu, and 1,000 others with funny names and animal logos. But what are they? Honestly, for the most part, they're lottery tickets. They typically don't have a deep, underlying technology or a real-world problem they're trying to solve. Their value is driven almost entirely by hype, social media attention, and community momentum. Can you make a fortune on them? Yes, in the same way you can win the Powerball. Can you lose your entire investment in the blink of an eye? Absolutely. And it's far more likely. A platform that lists hundreds of meme coins isn't necessarily better. It's just offering you more tables at the casino. It's giving you the freedom to make potentially life-changing bets, but also the freedom to lose everything. A platform that avoids them is taking a more protective, curated approach. There is no right or wrong answer here. It depends entirely on your risk tolerance and your goals. But you must know what you are buying. Don't mistake a lottery ticket for a blue-chip investment. Finally, there's one more category that is critically important for every single person starting out. Stablecoins. These are the safe harbors on our map. A stablecoin is a type of cryptocurrency that is pegged to a real-world asset, almost always the US dollar. Think of coins like USDC or Tether. One USDC is designed to always be worth $1. Why is this so important? Because the crypto market is volatile, swings up and down wildly. Stablecoins give you an escape hatch. If you think the market is about to crash, you can sell your Bitcoin or Ethereum and move that value into a stablecoin without having to cash out to your bank account, which can be slow and have tax implications. You can park your money in the stability of the dollar, wait for the storm to pass, and then buy back in when you're ready. They are an essential tool. Any platform you choose in the US must have a reliable, well-regulated stablecoin available. It's your home base, your financial anchor in a turbulent sea. So let's bring this all back to your choice. When you look at a platform like Coinbase in its basic form, you're getting a curated list. They've done a lot of the safety checks for you. They list the big ones, the established projects, and they are very slow to list new and proven assets. This is fantastic for a beginner because it reduces the risk of you accidentally buying into a fraudulent or low-quality project. The downside? You might miss out on the explosive early growth of a new, legitimate project because Coinbase waits for it to be more established. Then you have a platform like Kraken or Binance.us. They offer a much wider universe of assets. Hundreds of them. This is incredible for someone who has done their research and wants to invest in a specific smaller cap altcoin that isn't on Coinbase yet. It gives you more freedom and opportunity. But with that freedom comes immense responsibility. You are the one who has to sift through the good, the bad, and the ugly. You are the one who has to spot the scams. The platform is just the supermarket. It's not telling you which food is healthy and which is poison. So the question you have to ask yourself is, do I want a curated, safer experience where my choices are limited? Or do I want maximum freedom and access, knowing that it comes with higher risk and requires a lot more of my own research and due diligence? Starting with a more curated platform is often the wisest path. You can learn the ropes, understand the market dynamics with the major assets, and then if you choose, you can always open an account on a second, more expansive exchange later on. This isn't a one-and-done decision for life. It's about what's right for you right now. You've now got the map. You understand the difference between the continents, the big cities, the financial districts, and the casinos. You know the importance of having a safe harbor. You're starting to see how one platform's map can look radically different from another's. But a map is just one part of the journey. Now you have to think about the vehicle you'll be using. How much does it cost to drive on these roads? What are the tolls, the gas prices, the hidden fees? And is the car itself easy to drive? Does it have a simple dashboard? Or is it a confusing mess of 1,000 buttons and switches? Because the most detailed map in the world is useless if the cost of travel is too high, or if you can't even figure out how to turn the key. That's where we're going next. Untangling the web of fees and finding a user experience that won't leave you stranded on the side of the road. Let's be honest, the most powerful, secure car in the world is useless if the cost of travel is too high, or if you can't even figure out how to turn the key. That's where we're going next. Untangling the web of fees and finding a user experience that won't leave you stranded on the side of the road. First, let's talk about the money. The cold, hard truth of crypto is that nothing is truly free. These platforms are multi-billion-dollar businesses, not charities. They have to make money, and they do it through a labyrinth of fees. Your job is to find the platform whose fee structure hurts your wallet the least. The most common fee, the one you'll encounter on almost every trade, is the trading fee. Think of this as the toll you pay to use the highway. This often breaks down into two categories: maker fees and taker fees. This sounds complicated, but the concept is simple. A maker is someone who makes liquidity by placing an order that doesn't get filled immediately. You're essentially adding a new destination to the map. For example, if you say, "I want to buy 1 Bitcoin, but only if the price drops to exactly $60,000, you've placed a maker order. You're waiting for the market to come to you. A taker, on the other hand, is someone who takes liquidity from the market. You accept a price that's already available. If you say, "I want to buy 1 Bitcoin right now at whatever the current price is," you are a taker. You're taking an existing offer off the table. Because makers add stability and depth to the market, platforms reward them with lower fees. Takers, who want the convenience of an instant transaction, almost always pay a slightly higher fee. For a beginner, you'll mostly be a taker, but it's crucial to understand this distinction as you become more advanced. But trading fees are just the most obvious toll. The far more insidious cost, especially on so-called zero-fee platforms, is the spread. The spread is the silent killer of profits. It's the difference between the price you can buy a coin for and the price you can sell it for at the exact same moment. Think of it like a currency exchange booth at the airport. They might not charge a fee, but the rate they give you to buy euros is way worse than the rate they give you to sell them back. That difference, that gap, is their profit. It is the fee just in disguise. A platform might offer to sell you Bitcoin for $60,100, while simultaneously offering to buy it from other users for only $59,900. That $200 difference is the spread. You lose $100 the second you buy, and another $100 if you were to sell it right back. For platforms that advertise zero-commission trading, the spread is almost always where they make their money. It might seem small on a $100 trade, but when you're dealing with thousands, it adds up faster than you can imagine. Always check the spread. Then you have the fees for just moving your money around. Withdrawal fees are the price of exiting the highway. If you're pulling out US dollars, there's a difference. An ACH bank transfer might be free but take a few days. A wire transfer might be faster but cost you $25 or $30. More importantly, when you withdraw your actual crypto to your own private wallet, which, as we discussed, is a critical security step, you'll pay a network fee. This fee doesn't actually go to the exchange. It goes to the miners or validators on that specific blockchain like Ethereum or Bitcoin who process your transaction. Some exchanges will cover this fee, some will pass the exact cost on to you, and some will charge you the network fee plus a little extra for their trouble. A platform with high withdrawal fees can feel like a trap, making it expensive to actually take control of your own assets. So you've navigated the fees. You've calculated the cost of your journey. Now, the next question is, can you actually drive the car? This is the user interface and user experience, or UI/UX. And in crypto, there are generally two kinds of dashboards: the simple automatic and the complex manual transmission. The simple, beginner-friendly platforms like the basic versions of Coinbase or Gemini are the automatic sedans. They are designed for one purpose: to get you from point A to point B with the least amount of friction possible. The dashboard is clean, maybe even a little sparse. You see a chart, a price, and two giant buttons, buy and sell. It's beautiful in its simplicity. It's designed to prevent you from making a catastrophic mistake. The trade-off for this simplicity is almost always higher fees. That hidden spread we talked about? It's usually much wider on these simple interfaces. You are paying a premium for convenience, and for many people just starting out, that's a price worth paying. Then you have the advanced platforms, the Pro, or advanced versions like Kraken Pro or Coinbase Advanced. These are the manual transmission race cars. When you open one of these, you're not looking at a dashboard, you're looking at a cockpit. You'll see candlestick charts, depth charts, a live updating order book, and a dizzying array of order types like stop loss, take profit, and fill or kill. The learning curve is incredibly steep. It's overwhelming. But here's the payoff. The control is unparalleled, and the fees are a fraction of what you pay on the simple versions. The maker/taker fees can be 10 times lower, and the spread is razor thin because you are trading directly with other users on the open market. So which one is for you? You need to be brutally honest with yourself. Are you a buy and hold investor who just wants to purchase some crypto once a month and not think about it? Then stick with the simple automatic interface. The peace of mind is worth the slightly higher cost. But if you see yourself wanting to trade more actively, learn how the markets work, and save a significant amount of money over the long run, you have to commit to learning the manual transmission. The good news is many platforms offer both. You can start on the simple version and graduate to the pro version on the same platform when you feel ready. And don't forget the mobile experience. Most of your interactions will likely be through an app on your phone. Is that app well designed? Does it crash? Read the reviews in the App Store or Google Play. A poorly made app that freezes during a moment of high market volatility isn't just an annoyance. It's a liability. It can literally cost you thousands of dollars if you can't close a position when you need to. Finally, consider the on-ramp itself. How easy is it to sign up and get verified? This is called the KYC, or Know Your Customer process, where you upload your ID to prove you are who you say you are. On the best platforms, this is a smooth 10-minute process. On the worst, it's a multi-week ordeal of rejected documents and useless support tickets. A clunky onboarding process is often a red flag for how the rest of your experience on the platform will be. So the perfect choice is a delicate balance. It's a trade-off between the cost of the tolls and the ease of driving. For the absolute beginner, starting with a simple, user-friendly interface is the safest bet, even if it costs a bit more. You can always move to a more advanced platform later, like learning to drive in an empty parking lot before hitting the freeway. You can even use a hybrid approach. Use a simple platform to easily buy crypto with your bank account, then transfer it to an advanced platform for cheaper trading. You've now checked the engine, kicked the tires, reviewed the security, and calculated the cost of the trip. You know what kind of driver you are. But there's one last critical step before you hit the open road. What happens when you get a flat tire at 2 a.m.? Who do you call? That's customer support. And in the wild west of crypto, having someone to call can be the difference between a minor inconvenience and a total loss. That's what we're covering in our final part. Think about it. In traditional banking, if your card is stolen, you call a number, they freeze it, and you're protected by federal law. In crypto, if you send your Bitcoin to the wrong address, it's just gone. Forever. There is no undo button. There is no central authority to appeal to. The platform's customer support is your only line of defense. It's the thin line between a simple mistake and a catastrophic loss. So what are the real-world scenarios where this becomes life or death for your portfolio? Imagine it's 3 a.m. on a Saturday. The market is going crazy. You see a perfect entry point for a trade you've been waiting for all week. You log in, but your two-factor authentication code isn't working. The app just keeps saying invalid code. Every second that ticks by, your opportunity is slipping away. An email to support might get a response on Monday. A live chatbot will just send you a link to a generic FAQ page. What you need, right then and there, is a real human who can troubleshoot with you and get you back into your account. Or consider this, you make a large deposit from your bank. The money leaves your bank account, but it never shows up on the crypto platform. Hours go by. Then a day. Panic starts to set in. You need to talk to someone who can trace that transaction, who can look at the back-end systems and tell you what's going on. A platform with only email support in this situation feels like screaming into the void. The gold standard, though incredibly rare in the US crypto space, is 24/7 phone support. The ability to speak to a human being is a massive green flag. More common and perfectly acceptable is 24/7 live chat with a real person. The key is to test this before you commit your money. Go to the platform's website. Find the Contact Us or Support link. Start a live chat. Ask a simple pre-sales question like, "Can you tell me if your platform supports limit orders on Solana?" Or, "What are the withdrawal limits for a newly verified account?" Now, pay attention to two things. First, how long does it take to get past the bot and connect with a human? If it's under 5 minutes, that's a great sign. If you're stuck in a queue for 30 minutes or can't get past the bot at all, That's a major red flag. Second, what is the quality of the answer? Did they give you a clear, concise answer? Or did they just paste a link to a help article you could have found yourself? This simple 5-minute test can tell you almost everything you need to know about how they'll treat you when you have a real problem. If they only offer email or a ticket system, look for a service level agreement or SLA. This is a promise of when they'll respond, like within 24 hours. But also go to Reddit, go to Twitter. Search the platform's name plus terms like locked account, support, or withdrawal problem. See what real users are saying. Are the stories filled with quick resolutions? Or are they horror stories of people waiting weeks for a response while their money is in limbo? Don't underestimate the power of social proof. A slick marketing page is one thing. A dozen angry Redditors with the same unsolved problem is another. Remember, when things are going well, you'll never need support. But in crypto, you have to plan for the day things go wrong. And with that, we've reached the end of our journey. We've covered the entire landscape of choosing a crypto platform in the USA. Let's take a second and look back at how far you've come. We started with the most critical foundation, security. We talked about why things like two-factor authentication, cold storage, and proof of reserves aren't just buzzwords, but the very armor that protects your assets from hackers and collapses. You learned that a platform's security is non-negotiable. Then we demystified the labyrinth of fees. We broke down the difference between maker-taker fees, spreads, and those sneaky withdrawal and network fees. You're no longer someone who will be surprised by hidden costs. You now know how to read a fee schedule like a pro and calculate the true cost of your trades. We moved on to the fun part, coin selection. We discuss why a platform with thousands of coins isn't necessarily better than one with a curated list of 20. You learn to look for platforms that support the specific projects you believe in, not just the ones that chase every new hyped-up token. From there, we tackled user interface and experience. You now understand that a clean, intuitive design isn't just about looking pretty. It's about preventing costly mistakes. You know the difference between a simple, beginner-friendly interface and a complex, professional-grade trading terminal, and you know which one is right for you to start with. We waded into the deep waters of regulation and compliance. You learned why operating in the USA is a big deal, and why choosing a platform that is licensed, follows KYC and AML laws, and is transparent about its legal standing is one of the smartest defensive moves you can make as an investor. We explored the world of advanced features, from staking and earning interest to NFTs and derivatives. You now know that your first platform doesn't have to be your last, and you can choose one that has room for you to grow as your knowledge and interests expand. We covered the crucial, often overlooked aspects of liquidity and order books, understanding why a platform's ability to fill your orders at a fair price is the engine that makes everything else work. We talked about deposit and withdrawal methods, ensuring you can actually get your money in and, more importantly, out using methods that are convenient for you. And just now, we finished with customer support, the emergency hotline that can save you from financial disaster. You have all the pieces of the puzzle. You are now more informed than 99% of people who throw their money into crypto on a whim. The confusion is gone. In its place is a clear strategic framework. So what's next? I want to give you a final actionable mission. I call it the 3-platform challenge. Based on everything you've learned, I want you to pick 3 US-based platforms that you think are your top contenders. Maybe it's Coinbase, Kraken, and Gemini. Maybe it includes Uphold or Crypto.com. The specific names don't matter as much as the process. For each of those 3 platforms, you are going to be a detective. 1. Go to their website and find their security page. Do they talk about cold storage? Do they have third-party audits? Check that box. 2. Find their fee schedule. Don't just glance at it. Actually calculate what a $100 purchase of Bitcoin would cost you all in. Write that number down. 3. Verify they have the top 1 or 2 crypto assets you are most interested in buying for the long term. Don't get distracted by the hundreds of others. 4. Run the customer support test. Open a live chat or send an email with a simple question and time the response. Judge its quality. 5. Find their licenses or legal page. Confirm they operate legally in your specific state. After you do this for all 3 platforms, you will have your answer. The confusion will evaporate. One of those platforms will clearly stand out as the right choice for you. Not for me, not for some influencer on Twitter, but for you. You started this journey as a beginner, full of questions and uncertainty. You are finishing it as a prepared, informed, and confident investor. You've done the work. You've put in the time to educate yourself, and in this market, that is the single greatest advantage you can have. The world of crypto is still the new frontier, but you're no longer stepping into it blind. You have a map, a compass, and a clear understanding of the terrain. The next step is yours to take. If this series provided you with the clarity and confidence to begin your journey, do me one small favor. Hit that subscribe button and share this series with one friend who you know is curious about crypto, but is too afraid to start. Let's build a smarter, more informed crypto community together. And now I want to hear from you. Based on your own research, what platform are you leaning towards and what was the single biggest factor in your decision? Let me know in the comments below. I read every single one. Thank you for your time and attention. Now go build your future.